We continue with partnership. We're going to activity 1. It says Smith and Jones decided to go into partnership with Smith would contribute £30,000 and Jones would contribute £20,000. It was agreed that Jones would work in the business and receive a salary of £5,000. That makes Jones an active partner. An interest of 10% per annum was to be allowed on the capital accounts, and partners were to share the remaining profit in the ratio of 60% for Smith, 40% for Jones. The business makes a profit of £140,000 in the first year. So that profit is a profit before the adjustments.
Okay, so what does annual mean?
Yearly. So now we have to prepare the accounts. So we have Smith and Jones. So we have the debit and the credit balance. So the profit for the year is, before the adjustment, is 140,000. That is where we start taking away the interest on capital, whatever we have to, we take it away from there. And whatever we need to add, we add it to it. But note, from your profit for the year adjustment, before the adjustment, interest on capital will be deducted from the profit for the year. Interest on loan, if the interest on drawings will be added, salary will be deducted. That is all we need to do here. So we have the profit for the year before adjustment, which is 140,000 done. Interest on capital introduced, 10% for, it's 10% each anyway. So for the capital, 30,000 for Smith and 20,000 for Jones. 10% of 30,000 is the interest.
3,000.
10% of 20,000 is 2,000. So that will be deducted from here. And Jones is collecting salary. He's going to get the salary of 5,000. So those are all the subtractions you have to make. 3,000, 2,000, 5,000. That's 10,000. So 10,000 minus profit for the year before adjustment is 130,000. Is it clear? So this is what the profit that has to be shared between Jones and Smith.
Yeah.
From the 130,000, Jones is expected to get 40%, and Smith is expected to get 60%. So 60% of 130,000 is 78,000. 40% of 130,000 is 52,000. So that is the activity 1.
Yeah.
Done. So when you add them together, you still have your 130,000. Activity 1 done. So we go to activity 5. It's a long one, but we did it. So Tanaka and White. Tanaka and White share profit in the ratio.
You're so good, Mr. You're one of the best teachers.
Thank you. 7:3. The balance on the capital account is written. We have the balance on our capital account. For Tanaka, 300,000. For White, 180,000. We have the current account balance. For Tanaka, 20,000. For White, 14,000. So the first thing we have to do here is to prepare the interest on capital and the interest on current accounts. So we have capital account, current account. Then we have drawings. Drawings are for Tanaka, 31st of July. For Tanaka, the drawings for Tanaka, the drawings for White, they are there. So the additional information, interest is charged on drawings at the rate of 10% and salary for White for 25%.
Yeah.
So we're back here now. So we have the additional information. White is to earn a salary of 25,000 per annum. So the price for the year of the partnership for the year ended is 31 May 2019 is 126,700. They said we are to prepare the partnership appropriation account for the year ended.
Mr. Latif, 126,000 for year ended, yeah?
That's the profit.
Profit, okay.
And show the current account of each partner at 31 May 2019. So we're going to start with the interest. So the first thing we have to do is to prepare the interest on capital account for Tanaka and White. The capital account has 300 for Tanaka, 200,000, 180,000 for White. So it is 6% interest. So 6% interest of 300,000 is 18,000, and 6% interest for White is 6 over 100 multiplied by 180,000, which is 10,800. So that's the interest on capital. You prepare it separately. Then the interest on current account. The current account has a balance of 20,000 for Tanaka. It's in there.
Yeah.
And 14,000 for White. So 6% of 20,000, 1,200. 6% of 14,000, 840.
840, yeah.
That's about that. Now, we have the interest charged on drawings. So the drawings, it has a separate situation here because it has to be for each month. And you have to calculate for each month.
Mm-hmm.
So the date of the drawings for Tanaka, we start with Tanaka. The interest charge on drawing is 10%. So the year ended at 31 May 2019. 31 May 2019. We're back here now. Sorry for the breaking transmission. So we have...
Mr. Abdul Latif, please explain me, we have to do partnership and current account, yeah?
Hello, we have Tanaka. So we're going to capital account now, the interest charge on the drawings. So we have to calculate it for each month. So for Tanaka, we have 31st of July 2018, 12,000. So how to prepare it, you write the amount, which is 12,000, the date of the drawings, the numbers of the month, then the interest charged on each month. So for 2018, we have 12,000, 31st of July 2018. So from July 2018 to May 2019, that's 10 months. So it will be 12,000 multiplied by 10%, 10%.
Times 10.
Yeah, 10%. That's 1,000 multiplied by 12,000 multiplied by 10 over 100. So we have 1,200 for the whole year annually, but we have only 10 months. So it will be
200.
It will be 1,200, which is the whole year, in 10 months. So how much divided by 12? It is 100. Do you get it or not?
Yeah.
Each month has 10, 100.
So for Tanaka, for the 10-month period, you have to find how much per month.
Per month, the total month,
Yes,
the total month is 12 months.
Yeah.
In 12 months, we have 1,200. Each month will be divided by 12, which is 100. So 100 in 10 months is 1,000. Is it clear now?
Yeah.
So that is for the first month. Then the second one, 10,000 from 30th November 2018, which is 6 months. So how do you calculate that? We already know it is 1,000 for the whole year, right? For 10 months is 1,000. So 1,000 divided by 12 multiplied by 6. 1,000 divided by 12 multiplied by 6, which is 500. For 6 months is 500.
Yeah.
And for the last one, which is 2 months. So 100 multiplied by 2, because each month is 100. 100 multiplied by 2. So for the 12,000 it is 1,000 interest. For the 10,000 it is 500 interest. For the 12,000, which is for 2 months, is 200 interest. Clear? That is the interest charge on drawings for Tanaka. Then the interest charge on drawings for white. We have 6,000, 31st of July 2018 to December 31 to 31st of May 2019. That's 10 months. That's 6,000 multiplied by 10 over 100, which is 600 divided by 12, which is 50 multiplied by 10, 500. For the 2,000 in 6 months, for Tanaka, for white.
But Mr. There's a month period, like July, November. How do you do that?
We did it. From July to what?
So like from July to May, June, it is how much months?
10 months.
From November to May, June?
6 months.
6 months. You have to, okay, I understand.
So
you're so smart.
Thank you. 31 of March 2019 to May, that's 2 months. And don't use smart for a teacher anyway.
What are you then, mister?
I'm a teacher, that's
perfect, amazing teacher.
31 March 2019 to May, that's 2 months, which is, so look at the calculation. 6,000 multiplied by 10 over 100, that's 600 divided by number of months, 12, 50. Multiplied by 10 months, 500. 2,000 multiplied by 10 over 100, 200. Divided by 12, multiplied by 6 months, 100. 6,000, which is the third one. 6,000 multiplied by 10 over 100, 600. Divided by 12 times 200. Is it clear? So we have 500, 100, 100 for the interest charge on drawings.
Yeah.
For white. Now that takes us to preparing the appropriation account.
Wow, you even did that, mister?
Sure.
So
smart. Tanaka and White's profit and loss appropriation account for the year ended. So we have our profits, which is before the adjustment, which is 126,700. So we had interest on drawing. Because interest on drawing will be paid into the business. It increases your appropriation account. We talked about that before. Yeah. So interest on drawings for Tanaka is 1,700. We have it here.
Yeah.
Let's put the activity together separately. We have it here. For Tanaka, this is interest on drawing for Tanaka. For white, 700. For Tanaka, we have it on the other one, which is 1,700. It's not written, but you have to add this together, which is 1,700. So 1,700 plus 700 gives us our total interest on drawing, which is 2,400. You add it up to the profit for the year because it's interest.
Yeah.
You had it, so it gives us 129,100. Now, interest on capital. Interest on capital for Tanaka is there on the capital account.
It is 1,700.
18,000 for Tanaka interest. Tanaka interest on capital.
Oh, 18,000. Yeah.
Do you get it or not? This is it. 18,000. Interest on Tanaka is 18,000 and white.
Stuff so clear, mister. Thank you.
Welcome. 10,800 for white. Interest on capital. You have to take it away from the profit. Interest on current account. Tanaka 1,200 in your current account is
Yeah.
there. White 840. You add it together. That's 25. And White is going to get a salary of 25,000. So you add all together. Then you take it away from the profit. Note, profit for the year. You had interest on drawings. You less interest on capital. You less interest on
Did you
current
write that
account.
formula down, Mr.?
I did that. So all this will be taken away. So that gives us our profits. So the profits now, when you take away the interest on capital and the interest on current account, it gives us 73,260. Then you go to the additional information. They said the profit for the year of the partnership. Okay, they said additional information here. Go up, sorry, above it. Tanaka and White share profit in the ratio of 7:3. So here, look at it, please. Share of profit. The profit is 73,260. The share of profit is 7:3. So Tanaka will take 7 and White will take 3. So how do you get your share ratio? 7 plus 3 is 10.
Yeah.
So 7 for Tanaka over 10 multiplied by the profit, which is 73,260. White is 3 over 10 multiplied by 73,260. So 7 over 10 multiplied by the profit, 3 over 10 multiplied
Minus
by the
them.
profit. You add them together.
Yeah, add them together.
To show you the profit. The profit is profit for the year
Yeah,
plus
profit,
interest on drawing minus current account interest minus capital account interest. It gives you 73,260. Then the share of profit 7:3, which is you add it together. Done.
Now,
Then we prepare the current account.
even that,
Yes, please. So for the current account, we have the debit side and the credit side. The debit side will have drawings, interest on drawings, salary that is due for the year, and the balance.
what format is this? The current as current.
It's just like a ledger. It's a current account. It's a ledger.
Current account.
So our drawings, we have 47,000 for drawings. The total in your drawings account,
Yeah.
47,000 for the month that we calculated together. The total is 47,000 for Tanaka. The drawings for the current account for White, the total is 17,000. The interest on drawings, we have it on the other account, 1,700 for Tanaka.
Yeah.
These are still on the debit side, 700 for White. The salary paid, White is only due for salary, which is 25,000. You leave that side. On the credit side of our current account, we have our balance brought down, 20,000. The balance, it's there, 20,000. In the partners,
Yeah,
balance.
Balance 20,000, okay.
Yeah, that's balance for current account. 20,000 for Tanaka, White 14,000. Clear? The interest on capital. The interest on capital, we have both capital and current account. You have to add them together. That's why I wrote it here. Note, interest on capital will be added to interest on current account. Tanaka will have 18,000 interest on capital plus 1,200 interest on current account, which means 19,200. Then White, 10,800 interest on capital, interest on current account 840. You add them together, 11,640. White is due for salary 25,000. You add them together, and the profit has to be added together with it. The profit that has been shared in the appropriation account, you add it on the debit side. So your debit side will have the balance brought down, the interest on capital and interest on current account, the salary due, and profits paid. So it gives us 90,552 for Tanaka in the current account. So the current account balance for Tanaka is 90,552. The current account for White is 72,648. So the debit side is smaller than the credit side, so it will give us our balance carried down.
Perfect.
Is it clear?
Yeah.
So that is activity 1 and 5.